Hello, this is Mike Swanson of WallStreetWindow.com. Thanks for joining me. It's 4 o'clock Tuesday. Tomorrow is going to be the Federal Reserve meeting. And one thing, if you're coming to the recording of this video and you want to see the next one live, hit the subscribe button below the YouTube video and hit that bell thing, because then you'll get another notification. You'll be able to join us when we're live. But I'm here with David Skarica, who runs the website addictedtoprofits.net. How you doing today, Dave?
Good, Mike. How you doing? I'm doing better than the stock market is.
Well, it's not crashing today. It's not a collapse. Oil is down 7% in one session. That is pretty. It's a pretty big drop. But yeah, yesterday was a big down day. I do think the picture next year is going to be a really nasty one for people in the stock market who weren't positioned correctly. Which is to reduce risks, in my view, and getting things going up, because there are things going up. But, we got this, we're oversold. Is it possible we could see some sort of Christmas rally finally? What do you think?
Well, I think that, it really, I think it will depend on the Fed. And I'm not someone who usually is trying to stake everything on these Fed meetings, But if you go look at it, I think one of the major problems that no one's really talking about, because they're all focused on interest rates, is actually the balance sheet of the Fed is maybe more important right now. And they have $50 billion rolling off right now a month. And what that essentially means is they are reducing the size of the balance sheet by $50 billion. So they're not selling anything, but whatever they own expires, they're just not repurchasing it. But that's almost like selling it away, because all of a sudden, if they own $50 billion in treasuries and that comes off, well, that $50 billion has to go somewhere and be absorbed somewhere, right? So remember when they did quantitative easing, the idea was they're buying mortgage-backed securities, they're buying treasuries, and basically taking people out of those markets. And then that money that would go into that, which is, more conservative type interest-bearing investments, would have to go into the stock market, would have to go into riskier things. They're basically, we're trying to get people to take risks. And if you actually look at it, that $50 billion a month is, and it's kind of like when they juiced the stock market in 2013, the quantitative easing, when they were printing 80 a month. Well, when they're printing 80 a month, it was like an interest rate on top of interest rates being zero. It was almost like an interest rate cut every month. So for through all 12 months of 2013, they were doing an interest rate cut on top of already having rates at zero. Well, now it's like they're raising rates. This is going to be the fourth rate hike this year. Plus, since the balance sheet started shrinking in October, it's like a rate hike a month too. So you do the math, it's like you've had 3 rate hikes since October, and you've had 4 rate hikes this year. So it's more like they've raised rates 7 times this year, and that $50 billion keeps coming off. Say for the next year, let's say they raise once or twice more next year. That's like 14 rate hikes next year, 13, 14 rate hikes because of those liquidity problems. So I think one thing that people might want to look, wanted them to see is if they're going to not allow that 50 billion to come off and essentially just roll it over. But I really don't think they're going to do that. I don't think they're ready to be, because that's almost like easing if they just start keeping the balance sheet where it is. So I don't think they're going to do that yet. And that's why, who knows, maybe the stock market, we're getting so close to the holidays now. They meet tomorrow. Then we don't really have 2 trading sessions to Christmas Eve. The Friday trading session is probably going to be quite, small because, in terms of light volume, essentially almost like a long weekend with Christmas Eve being Monday and Christmas being Tuesday and Boxing Day Wednesday. So I don't know if you'll see some kind of light volume bounce. It's hard. Who knows in the short term? What I do think we're set up for, and this happened in the last 2 bear markets. If you look at the last 2 bear markets, you had a topping year, 2000, 2007. And then you had a big down year the next year, 2008 and 2001. And in each case, the first quarter was a miserable quarter with the market bottoming in about March, April, and then rallying into the spring, to about May or June. So I think that's kind of what we're setting up for, is a miserable first quarter, regardless of what happens. And you go look at the market right now, we've had this huge, I would say, topping pattern in place in the S&P and Dow and NASDAQ since January. The Nasdaq and the S&P and the Dow all went to new highs in September, October, but now we're right back to those lows. So we may bounce here, we may rally a bit off those lows, but I think when those lows break, that's a very significant 1 year topping pattern.
Well, one thing I want to add about the Fed, just so people know, right now Fed fund futures are pricing in a 77% chance of a rate hike tomorrow. However, this is critical. The Federal Reserve previous statements, really for the past 6 months, have projected 3 rate hikes for 2019. 3, and the thing is, no one trading the markets, no one in the trading bonds and the bond yield curve doesn't believe 3 rate hikes are coming next year, and neither do the Fed fund futures. So I would assume, based on that if they probably will raise tomorrow, but they will have to backtrack on their predictions of 3 rate hikes next year, and that will probably be interpreted by Steve Leisman and all the people on CNBC and these financial channels as a dovish event, a reason to buy stocks, and we could hopefully see a little bit of buying coming in the market. If that buying happens, do you think people should just go in and buy more stocks and drive up? And because these people, or is this the bad thing to do? Because these people also were predicting midterm rallies, Thanksgiving rallies, and we haven't yet, Christmas December's not working out the way it should. But people really want to play a rally now. They want to play one bad.
Well, first of all, I'm still not as certain we're getting some huge bounce if they do that. And the reason being is, like you said, that's basically been discounted in the market. I got the Fed fund futures now, and I'm showing people the probabilities. And if you go look at it, like this is June of next year, there is only a 20. Well, there's 5 here, so there's about a 30% probability the Fed funds rate is going to be 250 to 275 or higher, which is only 25 higher. That's middle of the year next year, right? This is where we're going to be after this one, right? So there's only roughly, a 30 to 31% chance that that's going to happen. So let's just go out into December 2019. Okay, and you can see here now there's still it's at 57% chance that Fed funds futures are actually going to be here or lower next year. So there's now only roughly a 47% chance or 43% chance that the Fed funds futures are going to be even 1 rate hike higher. So what I'm trying to say is I think the market's already kind of priced that in, right? And I think the thing about that is it means that balance sheet is actually starting to become more important. And by the way, you're talking about these people like Steve Leisman and people on CNBC. And I can tell you, I do watch these shows once in a while, more to get a gauge of how the mainstream media people are kind of thinking. And actually, even on shows like Fast Money, where they usually just pump stocks, right, and talk about quick trades and whatever, they actually are even talking about the balance sheet being important. So I actually think we're getting to the point where it's not just, they're going to stop raising rates next year. No, I think it's actually important for them to start addressing that balance sheet. But my personal opinion is, when I think about it, right, when I really think about where the markets and the balance sheet, I don't see the Fed reversing course that quickly. Okay, they're now maybe going from saying 2 or 3 rate hikes next year to maybe 0 or 1, but the balance sheet I think is another thing altogether. And that's something I think that's going to take a lot longer for them to reverse course on. Yeah,
I think a lot of people have this perception that if the stock market falls, the Fed will do something to make the stock market go back up, as if that's all they care about. But those last 2 times we had bear markets, the Fed didn't lower rates in response to the stock market, but in response to weak economic data. In 2000, there was a collapse in investment spending in the first quarter, in the fall of 2000, and the stock market was sliding for months. And then the Fed and Greenspan responded to that economic data. In 2007, it was really the collapse in real estate prices and the Fed seeing that affect the LIBOR rate for banks and the credit market. That's what they were responding to, trying to stop a crisis there. They don't really care about the stock market as much as people think. And I think at some point, and it could happen tomorrow, we may see the Federal Reserve come out and say, okay, we're watching economic data now. That's really what we're focused on, and not predicting 3 rate hikes or watching the stock market even. And I don't really have any idea myself. I mean, I think the stock market's going to fall next year. You laid out a scenario I think is likely a decline into the spring. Maybe we can bounce, hopefully, before this year's over for people to get out at some higher prices. But if we do decline in the spring, I really have no idea if that will impact the economy or not, or if the economic impacts won't be for another 12 months. I don't really know.
Well, and here's what I want to show. This is kind of interesting. This is a 5-year chart of the S&P. So you can see this potential topping pattern here, right? And then you can see it actually did trade a lot different than 2015, where the market kind of just churned for months and months before these corrections. This time it was much more of a straight up move after the first correction here in the spring. And what's interesting, though, if you go back to this October 2014 period, essentially this was like a 2-year trading range with the S&P at roughly 2,100 to 2,200 on the upside and about 1,800 on the downside. And during that early 2016 correction, it actually held the October 2014 low roughly, right? And then turned around. So right now we're right at the lows of earlier in the year. And if we don't hold that, that's bad. Here's the thing that's really bad. I also just was quickly looking at the VIX. You can see back in 2015, there was a huge spike in the VIX, just like there was earlier this year. But note that on the kind of the retest of the low or the low of the market, the VIX spiked back to over 30. What we haven't on this whole decline, and one reason I think this decline's continued to happen, is we haven't even gone over 27, 28 yet on the VIX. We haven't even gone to the 30s. Despite
What's the VIX at today?
It's at 25. It was actually up today, even with kind of a flat day in the market. The S&P was essentially flat today, up a point or something, right?
I would suggest perhaps that might be the only positive thing the stock market has going for it at this moment is the VIX is at 25. And the last time it was at 25, it did bounce. So I don't think that means it's going to be the bottom and go up from there. But I think that can provide us some hope that we can see a little bit of a bounce at least.
Yeah, well, if you look at these two, if I get a shorter term chart and we look at these two bounces that just happened in November, both in November, you can see the VIX, these coincide with what you just said, to the VIX going 25 to 27. So I could definitely see a move back up, I don't know, 100 points in the S&P to 2650, something like that before it moved lower. But I really don't want to try to time it like perfectly. I think I want to be what I think is in the trend. And, I've been shorting for months and months and months. So I rather just see, what's going to happen. And if I'm right, I really think it will be like the first quarter of 2008 or the first quarter of 2001 where the market gets rocked. And I think one thing people are throwing around these scenarios, like I showed the 2015, 2016, and people are saying, oh, just like 2015, 2016, there was a big correction in August, and then in February 2016, it retested, and then it went straight back up. This is just the same thing. It's happened in February, now it's happening in December. But you have to understand what went on. Number one, okay, the Fed only raised, first of all, rates were a lot lower, right? The Fed wasn't reducing the balance sheet. They only raised, we only had one, we had the first rate hike in December 2015, and they held it. So they're holding rates at zero. Even if they hold rates now, they're gonna be holding rates at 2.5%, right? Not at zero. And then Europe came with QE. Europe is now winding down QE. Japan came in with more QE. Japan is not printing as much now. China did a $1 trillion stimulus because their economy weakened a lot in 2015. Well, China doesn't look like they're coming up with any stimulus right now. So energy prices, which had bottomed in 2014, actually kind of slowly moved higher throughout 2016. Well, now energy prices are kind of falling apart. So I think the backdrop is a lot different. And I think a lot of this backdrop is because we've seen so much stimulus. We saw $4 trillion at QE. We saw zero rates for nine years. We've seen so much easy money for so long. I think what's happening is the central banks, especially in China and the United States, they're going to be a little more reluctant and slower to just start pumping stimulus again because they've pumped so much. And if you know anything about what Kyle Bass is saying, Bass's argument is that they have, a lot of, they have US dollar reserves, but a lot of their reserves are in yuan. One of his arguments is the reason they're not going to do this again is actually China is actually starting to run low on US dollars. So they actually can't use US dollars for stimulus as much. They basically, if they do use stimulus, they have to use yuan, and that's a lot less effective because you can't do it in the foreign markets. You can only do it maybe in the domestic economy. But anyway, I don't want to get to those parts. I just think the backdrop is a lot different now. And here's another reason too. I'm just going to go look at this is a stock that you and I have liked to talk about because it was just such a parabolic leader of this move. And you can see NVIDIA. Look, NVIDIA is right back on its lows now. And this totally fell apart from 290 to 145. This went down 50% essentially in 2 months. And if we go back, when NVIDIA did correct a bit in like 2015, 2016, note that this correction actually didn't. Sorry, I was wrong. It was 2017 where it corrected. It didn't even correct. So again, that's another sign. A leadership stock like NVIDIA, when we had the correction in 2015, 2016, didn't even really go down. And now it's getting absolutely brutalized.
It's a disaster. And the thing about, one thing we were talking about this together this morning is there have been $1 trillion worth of share buybacks in the stock market. And this 6 months has seen record share buybacks, an explosion in the share buybacks. And the market is trading like this. So even with the share buybacks, it's not acting good. And NVIDIA is dying. It's killing people, that stock. It's killing people.
Well, there's one more thing I want to show people is that back in 2000, right, people, like when we're in these bull markets and manias, let's face it, even though you may own them in your mutual fund or ETF or, pension fund, most people don't sit there and own J&J, right? And I'm not talking about people with millions of dollars of diversified portfolios. I'm talking about the average person who's just playing the stock market, chasing hot stocks. They're usually chasing where the bubbles were. And of course, the bubbles in the 90s was in technology. So people own stuff like Cisco, like Microsoft, like the dot-coms. And when these kind of bubble stocks start in the bear market, what you can see is that in the fourth quarter of 2000, when just like the fourth quarter now, the market started falling apart, Cisco during this period went from $45 to almost $10 a share, right? So what's happening now, what I think, and you're seeing NVIDIA kind of doing it, you're seeing Netflix doing it, you're seeing Amazon doing it, you're seeing Apple doing it, you're seeing all these companies doing it, right? I think what's going on now, Mike, is essentially people are now that own these hot stocks, just like someone who owns Cisco in late 2000 are just sitting there waiting for bounces. But when the bubble kind of bursts in these hot stocks, you don't get the bounces and you never really get to get out. If you sat here and waited for a bounce in Cisco, the first real significant bounce happened in March of 2001, but the stock was, over 50% lower from where you held it in the fourth quarter of 2000.
Yeah, I want to show you something real quick. This is I opened up an account, Robinhood, a few months ago, and it shows you the stocks that the most number of people own, the 100 most owned stocks of Robinhood people. Number one is Apple. Number two, GE. Facebook is on the list. Microsoft is on the list. But NVIDIA is soon down on the list too. Amazon, Netflix, Twitter, NVIDIA, Tesla, Micron, all these kind of stocks. And all of them, every single one of them is below that 200-day moving average. Nvidia is actually one of the worst of the bunch, but some of the others are just as bad. And
Well,
this is the situation so many people are in. And the thing about it is they don't have to be, because there's other ways to make money. You mentioned short selling. Both of us have made money shorting some of these stocks because they dump faster in a shorter amount of time than they go up. And also, look, today gold is up. Gold stocks are up over the past few months while the stock market's been dropping. And one of the gold stock ETFs is up almost 3% in today alone. Utilities are up, REITs are up. There's some other defensive sectors up. There are things going up in this market, but those things aren't on the list of this 100 most owned Robinhood things. The masses are just oblivious to the places where money can't actually be put to be making money, because they're trapped and stuck in these crazy, silly stocks that were fun a year or two ago, but are no longer fun. The people need to get out of them. I wish they'd get out of them. I wish it would bounce so they could take advantage of the bounce and just get out.
well, what's interesting, Apple is probably, I mentioned Cisco before. And again, when we started, we both kind of started in the late 90s. The two of the most owned stocks I've ever seen were Microsoft, and Cisco at that time. I'm from Canada. A lot of people owned Nortel at that time as well, which, by the way, went bankrupt. But anyhow, like Apple's interesting because this is probably the most owned stock I've ever seen. It's more owned than Microsoft was in the late 90s. Virtually everyone I know owns this stock. Virtually everyone owns an iPhone. They like their iPhone, so they own Apple. And almost all these people I know, they're just looking for a bounce. And Apple has fallen from 230 to essentially 165 in this period. And if you do the math, that's 65 points, and that's a well over 20% drop in what was at one time the largest company in the world. So what these people are all doing is they're waiting for a bounce. And yeah, sure, could that bounce happen? Yeah, it might happen. Maybe it'll bounce back to 190 and go back to the 200-day moving average. But I don't know. It could just fall apart too. Like, I showed you Cisco and what happened to that in the early 2000s, right? And Microsoft, and happened to all those .coms is that they had a topping period, kind of like Apple topped in August and September, and then they just kind of fell apart and never really gave you a good exit on a bounce until it was too late. So again, I'm not saying that's going to happen, but that very well could be happening. Look, when you think about it, other than Apple doing buybacks and buying back their own stock, what is stock market essentially? It's supply and demand, people buying, people selling. Well, everyone and their grandmother owns Apple. Who is there to buy this stock to push it higher other than Apple buying their own damn stock, right? The buyback. So that's another thing about these things. They're so widely owned and they're so, owned already. I just don't see the buying power to take these things significantly higher. Netflix is another company. It's down 130 points, or about 30%, from its high of July. Of July. So a lot of these things are already down 30-40%. And one reason I think we'll have a bad bust in the first quarter as well. Now let me go show you a longer term chart of Netflix. Right, a lot of people just don't get in at the top. People weren't buying at 400. They're buying Netflix, say, a year ago when the market was getting hot. And this is a hot stock, I'd say 200, right? Well, if you bought 200, you're still up 35% in your Netflix. Well, what are you going to do? It's now December 18th. You're now 2 weeks away from the end of the year, from the end of the quarter. What is Netflix going to do, right? You might say, hey, January the 2nd, when the market's open, January the 2nd will be a Wednesday. I am going to sell my Netflix, take my gain, and I won't have to pay capital gains to 2020. Instead of if I sell it now, I got to pay capital gains this April. So I think a lot of these stocks, even though people are sitting on paper losses from the highs, they actually might have gains on, and they'll be selling Apple, they'll be selling Amazon, they'll be selling Netflix early next year and taking those gains from, say, if they bought these things in 2017 or 2016. And I think that's also where you're going to see some selling pressure come in early next year.
Well, when we were talking yesterday, I don't own it, but I do own several mining stocks. But there's one I don't own that you own, and it was up over 10% yesterday alone, 10% gain in a day, while all these other stocks are dumping and dumping and dumping. So how are you picking these stocks out that are going up?
I believe in
what are you doing to make money here?
I'm going to show you another sector. It's not gold, but okay. I just want to show it to you just so this is the casino stocks. I'm going to pull up Las Vegas Sands back in 2009. So I'm using basically like the John Templeton maximum pessimism investing techniques, right? So you can see the casinos all tanked. They have high debt loads. They're having a lot of debt. Back during the real estate bust was not a good thing. The liquidity crisis. And this stock basically went to $1. And you can see by the end of 2010 was trading at over at $30. Even by the end of 2009, within basically 6 months of its low, was trading north of $10. So you're looking for these kind of distressed companies. So the gold stock that we're talking about, I'm not going to name it because it's just kind of for my paying subscribers, is a stock that, like this, is down. I'm just thinking about the quick math. Yeah, the company's down over 95% from its highs. I've crunched the numbers. I don't think they're going to go under, and it will be hyper leveraged to gold. Just like when the credit markets turn around, if gold turns around and goes to 1,500, 1,600, all of a sudden this company's margins will expand. They'll be making money again. They'll go from people worried about them going under to making money. And just like Las Vegas Sands had this exponential gain. So not every gold stock I buy is like that. I own some smaller juniors. I own some ones that are very sound and solid and boring. But I do have a handful of the gold stocks that have had problems, say with their properties, high cost of production. But I've crunched numbers, and I really don't think they're going to go under. It would take another 5 years of gold being at 1,100 or 1,200 for them to go under. And these companies I want to buy because I think you'll get this kind of reflexive rally when it turns around. So that's essentially, and like you just said, that one is up 11%. I think now is a great time to buy these stocks because if the market dumps in the first quarter, I expect gold and precious metals to rally. And also, a lot of these smaller gold stocks have also seen the same kind of tax loss selling that we're seeing in the stock market. And when that selling clears out and gold rallies, or hopefully over the first half of the next year, I think you could see huge gains. And if we go look at I'm just going to show you an ETF. Go just look at what the GDXJ here did the first half of 2016, right? And just like now, gold was bottoming in late 2015. The smaller cap stocks are seeing tax loss selling, and this actually almost tripled in price just in the first half of the year. And a lot of stocks went up 5 or 10 times.
That ETF is up over 10%, I think about 15% since its low in September, while the stock market's down over 10% now. The S&P and these tech stocks are just collapsing. But I don't want to keep you much longer. So just want to tell people if they want to get on my website where I got a blog post with the video, just click below to get your trading alerts. Or if you're just watching this on YouTube, go to your website, addictedtoprofits.net. But can you tell people, what your pay service has, what it actually is that they would get?
Okay, right now I have a free service called Stock Chart of the Day. So a few days out of the week, we'll post a couple charts like these. I have some sponsor companies on it, so we post the charts of the companies. But that's basically a teaser like this, like showing you some charts. And then our pay service, we have 2 pay services. For the sake of this, we're just going to keep it on the silver or premium pay service. So with that, you get a couple podcasts a week. You get a video update every week. We have a watch list of companies, up to 12 companies, up to 6 short positions and 6 option positions. So that one stock that I'm talking about, obviously, give that to you. We actually also have call options on that stock as well. The long-term leaps that expire in January of 2020 to kind of play that stock if it potentially goes higher next year. So this is kind of what we're looking at here in the markets and what we're going to do going forward. And in our letter. So like I said, a couple podcasts, the video update, a watch list portfolios, and see what I'm doing is, and a weekly update. What I'm doing is I'm basically getting rid of doing, say, a monthly letter or something, and I'll do special reports. If I see an opportunity in a sector or stock, we'll do a report on the stock, because I think that's much more timely. And especially like, we were in the zombie stock market from about 2016 to 2018, and that also happened in 2013, 2014. When you're in a market where not much is going on, so you don't see the point of doing monthly updates. I'd rather do kind of like more like special situations. So that's what we do as well.
Yeah, that's a good point. I mean, this type of business or industry has been based on, you get a monthly letter in the mail, 10, 15, 20 pages long, and it's or a PDF like that in your email inbox. And what we have done is more and more gone to short, timely, more frequent information that are more like trading alerts or something about what's happening in the market at the moment, but also linked to these bigger trends. And these markets are now so fast moving that you really need information like you're talking about that's quicker. For today, not, I got this in the mail and what do I do with it? It's outdated. I mean, these.
Well, not only too is with technology, like when I do a couple of these podcasts, usually 10, 15, 20 minutes late, I'll do videos on Periscope, off of David Skarica on Twitter. And the thing about those is you got the podcast, you download the MP3, you just play it, stream it off SoundCloud. You can hook your phone up to it, and when you go take your daily walk for 20 minutes, just listen to the podcast, and you're not taking any time out of your day and that sort of thing. So that's why I am kind of moving to more interactive media like that, because I do think it's the future. Obviously, I do think there's still a place for research reports and written reports, but when you're dealing with people, busy lives or whatever, I think a lot of people don't have time to sit down and read an issue for an hour or two. So either a quick email update takes you 10 minutes to read, or listen to a podcast which doesn't interfere with the rest of your day, is kind of the way to go. Like if you're tired at the end of the day, what do you want to do? Sit there and read a long research report? Or again, just hook your headphones up to your iPhone or Samsung, or whatever you have, and listen to the podcast 5 or 10 minutes before you go to sleep.
Well, thanks for taking the time to talk with me and everyone else out there in YouTube land. If you're watching on YouTube, click like on the video too, so we know that you're there. Subscribe, and then go and check out Dave's website, and we'll talk with you later.
Yeah. Thanks for having me, Mike.